Ladies and gentlemen, it's 10 o'clock, so let's go ahead and call the meeting to order. First item of business is item number 2, approve the minutes of the meeting of July 9th, 2015.
Second.
Motion is second. All in favor?
Aye.
All opposed? Motion carries. Item 3, we have 4 items. Let's go ahead and take them individually. Item A, the report of judgments.
Second.
All in favor?
Aye.
All opposed? Motion carries. Item B is the MFS class action settlement proceeds of $448.83.
Second.
A motion and a second. All in favor? All opposed? Motion carries. Item C is the Nortel class action settlement proceeds in the amount of $742.30. Got a motion and a second. All in favor? All opposed? Motion carries. Item D is acceptance of the interim financial statements for the fiscal year ended June 30th, 2015.
Second.
Any discussion? You want to wait? Okay. We've got a motion and a second. All in favor? All opposed? Motion carries. Item 4, I think we can take these all at one. We have 8 applications for service retirement in addition to the payroll. Have motion and a second. All in favor?
Aye.
All opposed? Motion carries. Item 5 is approval of the claims docket. Got a motion and a second. All in favor?
Aye.
All opposed? Motion carries. Item 6 is approve the following applications for service retirements, and I believe we have 11. Motion and a second. All in favor? All opposed? Motion carries. Item number 7 is receive the report of death, authorize the payment of the $5,000 death benefit, and approve continuation of pension to the spouse.
Second.
Motion second. All in favor?
Aye.
All opposed? Motion carries. Item 8 is receive the report of death, authorize payment of the $5,000 death benefit, and authorize the secretary to make necessary changes. We have 3. We have motion and a second. All in favor?
Aye.
All opposed? Item number 9, receive the report of death and authorize secretary to make changes to conform on the following. We have 5 cases. We have motion and a second. All in favor? All opposed? Item number 10 is discuss and or authorize leading for results. Renee, you want to give us a little information on that, please?
The LFR has been updated from the original one that was done back in, I forgot now if it's like 2004. Anyway, we've updated the city standard where we've taken out some of the efficiencies and some of the budget requirements that were on the old previous documents. And the major change is on the strategic result, number 2, that was modified. We had an old strategic result dated by 2012. We will, and now, the strategic results on page 2. And the number 2 has been updated. Now we're at, by 2016, we are going to actually provide 4 seminars per year. So that is our new, correct, unless there's something like sometimes during open enrollments or we have other things, they may we may not be able to get something in that quarter just depending on what other sessions are being offered by the personnel department for other courses.
Okay.
And the only other, the other change we made was on page 4. We used to have the word competitive. It was so they may have a competitive and financially sound retirement system. We changed that to sustainable. We thought that the whole program was designed to be a sustainable more than competitive. That was more of a city decision on what benefit structures they offered.
Good. Anybody have any questions for Renee? A motion and a second on item 10. All in favor? All opposed? Motion carries. Item 11, investment consultant report. Jason, you're up.
Good morning, everyone. We have the July report and or July monthly report and then the quarterly report. I'm going to go through the quarterly report first. Very good report. Starting, if you would, just a background review of the capital markets on page 6. So we've talked a little bit about this last month. The one-year results for the period ending June 2015 were fairly muted. Generally speaking, U.S. stocks performed well. Non-U.S. stocks performed flat to slightly negative, primarily a result of currency, as we'll see, because actually economic growth in Europe and Japan was positive. Local stock performance in local currency was positive, but the impact of a rising dollar relative to a number of currencies was a major headwind of about 16% for U.S. investors to the downside over that period. Emerging markets were tough over that year and continue to be, primarily as a result of significant slowing growth in China, as we're seeing over the last month or so. Fixed income slightly positive, up about 1.86% as measured by the ag. Commodities, somewhat of a bloodbath, down 23% as the price of oil continues to plunge. What you don't see on page 6 is real estate, commercial real estate, or core institutional real estate. Very good performance for the one-year period. The Odyssey or the NCREIF Odyssey Index actually up almost 13.4% for the year. So real estate did well. From a style perspective, and we'll drill down a little bit more at the sector level, a very big dispersion between growth and value for the year. Growth significantly outperforming value. And it's actually fairly narrow in terms of what's working in growth, primarily healthcare. Healthcare, biotech within healthcare doing very well. The dispersion in large cap, Russell 1000 growth up 10.5%, the value index up 4%. You don't really have a style bias in large cap at all. You're primarily implemented through passive strategies, the SSJ index and Intech, but the Intech active component actually did very well for the year. Within small cap, even greater dispersion, small cap U.S. stocks, the growth index up 12.3% and value slightly positive at 0.78, so pretty big differential there. From a manager standpoint, fortunately, we think about Earnest. Earnest doesn't generally look like the index at all. Earnest is a relative value manager. They tend to underperform primarily when REITs are doing very well. REITs make up a pretty significant real estate investment trust. Publicly traded REITs make up a significant portion of the small cap value index. REITs did poorly in the quarter and really over the last year. And so Earnest looks fairly good relative to the value benchmarks. Just turning the page to page 8, kind of touched on this, but if we think about kind of what drives the various styles, value tends to be more heavily, the most significant allocation within the value index is both large and small cap is financials. Financials for the year within large cap was slightly negative. Within small cap it was up about 2% on a one-year basis. For the quarter, slightly positive. Other more value-oriented sectors, industrials, energy, and utilities, although utilities is very small, but you can see for the year all of those sectors are significantly negative in both large cap and then not quite so much in small cap, but that certainly had an impact. And then the one standout is healthcare. Within large cap, healthcare is up 8.7% year-to-date, and within small cap, up 18.8%. So really, that's where we're seeing that dispersion from a style standpoint. Page 9 touches on non-U.S. equity markets, and the one thing I wanted to point out was that difference, the impact from currency, from a rising dollar, from a strengthening dollar. And this can be a headwind at times, like it has been over the last year, but in the past, really from 2000 through 2012 or 13, it was a tailwind. This was a positive diversifier. But if you look at the second line there under the 1 year, local currency up 12.25%. So that's the MSCI EAFE benchmark of developed market companies in their local currency, up positive 12%. So the company's doing well, stock's doing well. But when you convert that back into dollars, so the MSCI EAFE, same company, same index weightings, it's just for U.S. dollar investors, negative 3.8%. So that currency impact over the year, because the dollar's rising, had a 16% negative impact to U.S. investors investing internationally. Going forward, we think that may even out, and there may be some opportunities there going forward, certainly within currencies. And this isn't intended to be, your international equities are not a currency play, but that does have some impact on returns. Moving forward to page 12 and turning to fixed income markets for the moment. Page 12 looks at the interest rate of U.S. Treasuries based on maturity. The far left is the far left corner would be the Fed funds rate. As we know, that's been kept at near zero since the end of 2008. When you hear about what is the Fed going to do, that's that point, that short end, very short end of the yield curve. Certainly expectations are that the Fed may begin to raise rates sometime later this year or into next year. But we can see intermediate to longer term, that's what the market is really predicting, where rates should be generally. And the light blue solid line is at the end of June. And so for the period from the end of March to the end of June, so for the quarter, rates went up. But from a year ago, end of June of last year, rates from the 6-year longer term rates have come down. So that's why bonds have been slightly positive. As we talk about regularly within your portfolio, you have much less sensitivity to rate movements within your fixed income allocation because you have such a small allocation to the benchmark, if you will. Much more of your fixed income is actively managed. The Western portfolio, which is a lot of credit, corporate credit, high yield, some emerging market debt, and other things. The Brandywine strategy, which is global sovereign bonds, so you have some credit as well as currency there, really designed to provide some other alpha generators, but it also introduces some other risks over the last several quarters where there's been a huge impact from a rising dollar. They've been hurt a little bit from emerging market exposure. Relative to the ag, relative to their own benchmark, a broad world government bond index, they've outperformed, they've held up okay. But relative to just a pure U.S. investment grade mandate, that's lagged a bit. Now turning to your portfolio, just broadly speaking on page 18 from a dollar standpoint, you began the 1 year period, so July 1 of last year, the portfolio had $658.5 million. Net additions, which would be cash inflows into the system from contributions, employee and employer or city, and then benefit payments out and any other expenses, was negative $20.8 million. Return on investment, which is growth in the portfolio, $28 million. So positive growth overall. For the 1 year at the end of June of 2015, you stood at $665.8 million. Relative to some longer-term policy objectives on page 19, if we look at the far right there, we look at some broad objectives from a return and risk standpoint. The one objective we don't show on here, which I think is the most important, is funded status, because that's also another, that should be the most important measure. It certainly impacts the city and the stability of the fund. That has certainly improved. This is just focusing on return metrics and not liabilities at all. But over that 10-year period, up 6.6% relative to your target assumed rate of return of 7.5. So that 10-year period, we haven't quite got there. But if we look at relative to a policy or what your asset allocation would suggest, you've actually outperformed that policy index over that 10-year period. So the markets just haven't delivered the type of return you need over that full 10-year period. Longer term, we go back 20 years, yes, you've achieved that hurdle. But from a risk standpoint, over 10 years, all of the risk metrics are lower risk than the asset allocation and objectives would suggest. So you're getting that return with much lower risk. 5-year period has been very good.
May I ask a question?
Sure.
How about the next 5 to 10 years? Do you feel the 7.5 is a fair number?
Over 5 to 10-year period, Randy, it's going to be tough. Based on our capital market assumptions, our intermediate term assumptions are probably 2 to 250 basis points lower than our long-term assumptions across the board. And that just simple math, not getting into real details, but if you start with the historical rate on cash, if we go back to 1952 with the advent of modern Fed policy, the average yield on cash has been about 4.5%. Well, today it's essentially 0. We extrapolate what the 10-year yield should be, because that's for a long-term investor probably a better proxy. It's the 10-year Treasury generally has about a 1.8% premium to cash. So right now that would indicate that the 10 years at 2.14, it should be about 2 point. Right, that's right about right if you think cash is at 0.25.
So a 200 to 250 basis point difference, is that what I?
Right. So large cap stocks, instead of being 8.8 or 9, they're more like 6 over the next 5 to 10 years. So to make a long explanation shorter, it's about our expectations in the intermediate term, 5 to 10 years, are much more muted than what the long-term expectations would be.
So would it be a fair statement to say that it may be something we would want to consider looking at that assumption?
Yeah, I mean, this is a question that comes up with a lot of pension boards, but the issue, I think the issue is what should the time horizon be? If we looked out over 25 to 30 years, we think a 7.5% is reasonable still. So the trade-off, as you know, is cost, moving that down. And certainly from an investment standpoint, a lower return hurdle is always more reasonable, purely from an investment standpoint. The probability of achieving 7.2% is higher than 7.5% with the same asset mix, because it's lower. You're going to go from, let's say, 55 to 60% probability. But the trade-off is cost and understanding what that does. So it's something that others are looking at. I think I just read this week that on average right now public pension funds, I think, are around 7.68% or so, which is a study by NASRA. I don't know if you get that information, but certainly they're coming down a bit. Most of our clients are still in the 7.5% to 8% range. I haven't seen any public funds go lower than that.
Randy, just to let you know, we are currently, the Plan Design Committee is currently reducing our assumed rate of return to 7%. And we'll be forwarding that information to the actuary, and then we'll be providing the information to the board at a later date.
Just really quick, when was the last time we lowered the assumption? Do you remember? Was it a couple of years ago, 3 years ago?
It's been about 4 to 5 years ago, we lowered it from the
8 to the 7.5. Thank you.
Just turning to page 20 and looking at the asset mix at the end of June, and it's roughly the same at the end of July, slightly overweight to equities and slightly overweight to fixed income. Real assets continues to be a little bit underweight as the opportunistic real estate continues. We haven't fully implemented that. That is something both in the next month or two, I'd like to come back with, we'll come back with some recommendations on both private equity and the opportunistic real estate, as some of those commitments that you have there are winding down, they're fully invested, and we need to continue to fund those two programs. Within equity, small cap continues to be the most overweight. At the end of June, it was 4% overweight. At the end of July, small cap is still about 4% overweight. So in terms of your ongoing cash operating needs, we would continue to recommend that come from small cap on a monthly basis if you need to raise cash. Page 21 is a page, I think we added this last quarter. You saw it just at the request of the board, just to get a deeper drill down on your emerging market exposure. In the target allocations, that emerging markets allocation where it's 5% and we show 4.5%, that's the dedicated emerging markets, so that's Vontobel and Wasatch. As you know, within your policy and the way you've implemented, you're going to get some EM exposure in some other areas, both equity and fixed income, and you've intended to do that. But this is designed to give you a look-through to see where your emerging market equity exposure is overall, as well as your total exposure to emerging markets. So that top line, market value, that's the total market value of the fund. Value of emerging market securities, $59.18 million. That is both equity and fixed income, and that is within commingled funds as well, so long-short equity and private equity. So total exposure of about 8.9%. The equity component of that, you have about 6.6% of your portfolio is in emerging market equity securities. If we drill down just on the long only, the combination of Vontobel, Wasatch, and then your two developed managers is right about 5%. Lazard and Harding Loevner add exactly 1% more exposure, so you're right at 5% target with the long only EM. Page 22, just looking at total portfolio risk and return statistics. We talked about return, and I did touch on those risk statistics, but with a funded status, I believe you're at or over 100% now. You don't need to take as much risk. While we still have that long-term return expectation, you want to continue to grow the portfolio, but you don't need to take undue risk to grow the portfolio. Participating on the upside, protecting on the downside has been the mantra, and we want to continue to do that. Since January of 2002, that's when we started measuring performance. If you look at the standard deviation in the upper right, it's about 70 basis points or almost 90 basis points lower than the asset allocation would suggest. Also, we don't compare here, but it's also significantly less than peers with similar equity allocations. Much of that coming from the hedged equity portion within the portfolio. You're hedging out a lot of the equity market risks, so that's capping some of the upside in good markets, but you're getting that back by not losing more in down markets. The other measures are the up and down capture measures, so that up capture measure, you're not getting 100% of the upside. You're getting almost 95% of the upside, so when the markets are up 10%, you're up 9.4% is what that means. But on the downside, you're capturing less of the downside, is what that's indicating. Page 23, just looking at returns relative to peers, we also have added here net of fees at the total portfolio level. The policy index and peer group indexes are not net of fees, but we're just showing your net of fees as well, just for the purpose for the comparisons is to have apples-to-apples comparisons. But if we look at, on a 3-year basis, net of fees, you're up almost 10.9%, so well ahead of that 7.5% net of all fees, ahead of the policy index, which is 10.29, trailing peers, but again, the peer group index would not be its gross of fees. So versus peers, you're actually in the 36th percentile, top third, essentially, over that 3-year period. 1-year period, while much more muted returns on a absolute basis, on a relative basis, you're doing very well. Net of all fees, 3.74% versus, I say net of all fees, net of all investment management fees. And this doesn't include custody and other administrative fees, which I think was asked, and that's probably another 2 to 5 basis points. Gross of fees, 4.34, which significantly outperforming the policy index, and ranked in the top quartile of funds between 55 and 70% equity. Just a note on peer groups. ACG has historically been, going back to the inception of our firm, we were a member of what was called the ICC, Independent Consultants Cooperative. The ICC has since kind of disbanded. It was a number of large consulting firms, and we created our own peer group with all of the consulting firms' data, along with a partnership with State Street. For the past couple of years, we have been using the State Street Trust Universe Comparison Service, which is all of State Street's custody clients and reporting clients. That peer group is starting to shrink the number of participants in that. So we are moving to the InvestorForce universe. InvestorForce is another vendor. Many of our peers have moved to that. It's a much more robust. The way they construct peer groups is a little bit different. From what we've seen, this is good or bad, from what we've seen, all of our client portfolios are going to rank much higher in that. It's not as selective, if you will. It's good in terms of what you're seeing. It's just a little bit different. I know there's been questions about peer groups before, but I just wanted to give you a heads up. Probably next quarter, we will be converting to that a different universe, InvestorForce, which is more robust in terms of numbers. Just a little bit different how it's constructed. We can slice and dice things a little bit more granularly as well. I think they have a number of different custom universes, like municipal plans under 100 million, municipal plans 100 to 500 million, 500 million to $1 billion, so you can look at a lot of different things. Ultimately, what really matters is what your asset allocation is. That's generally what peer group rankings are telling you. How do you, based on your asset allocation, how is that asset allocation done to what others are doing?
Jason, on page 23 there, the State Street bar, which bar would be comparable for our plan? The net of fees bar or the gross of fees?
The gross of fee.
Gross of fees.
Because the peer groups are not net. I mean, these are other institutional pools of money. Between what the universe we're using is other plan sponsors. So they're not all public funds. They could be corporate plans, and in this case, endowments and foundations that have between 55 and 70% of their portfolio in equity. So we're trying to isolate it more on an equity allocation because that's a better comparison from a risk standpoint, the type of, but it would be the gross number.
Right.
So your ranking of 26th percentile over a 1-year period is that 4.34% is in the 26th percentile of funds with 55 to 70% equity. Just a couple of comments. Moving to page 25. A lot of what I'm trying to point out is we've made a lot of changes to our reporting, some changes and enhancements. One of the things that you'll see on this page now on the far right is a since inception number. I just want to comment on that. Those since inception numbers, so if we look the total portfolio, the asterisk, the top line now, we're showing two lines, total portfolio. The one with the top line, which is asterisk, that's the net of fee number. So we don't have net of fees going all the way back. That's only going back 3 years now. That's how far back we went, because we had to reconstruct that, go back and get fees, because you pay fees out of different accounts than what we see. But the total portfolio second line is going back further. That since inception number ties to the date in parentheses next to that line, total portfolio 0102, so January of 02. So that since inception number of 6.54 is from January of 2002 till now. And that index, comparing it to, would go back to that point in time too. As you look down that column at the other since inception numbers, it's important to keep in mind that every one of those is a different time period. It ties to the since inception of that portfolio or composite or manager. Sometimes that's confusing. If you might be looking at two small cap managers and say, well, that one's done 6% since inception and the other one's done 12%. Well, one doing 6% is horrible. Well, it's because they're different time periods. So I just want to make sure that that's clear. And you can see that within your small cap. Your small cap growth manager Times Square is 18.9% since inception, and Ernest Partners is 12.28. Well, those are different time periods. One is from February of 2010. That's when you funded Times Square, and Ernest is May of 03. Both of them, the benchmark below that we're comparing to, is consistent with their inception date. So this is a good kind of just eyeball to see how have your managers done since inception. And if we go down the line, pretty much all of them, I think with one exception right currently, and that's a newer manager, Wasatch, which it was a little bit tough getting out of the gate, have all outperformed pretty handily since inception. The other thing, just want to point out, from an attribution standpoint, as you've outperformed your policy index over the last year, 4.34 relative to 3.2, the things that helped large cap, you see this better on the second page of the ASAP through the end of July. July was actually a slightly positive month, up 10 basis points, but your one-year return now jumps in a month to 6% from that 3.74%, because even though you're not adding a great month of July this year, you're taking off a bad month from last year. So your total portfolio is up 6% year over year ending July. What we show on this second page is just the composites, so not the managers, but if you look at large cap, your large cap composite up 12.86% versus the benchmark, which is the policy index component, 11.2. So your large cap portfolio has added 1.6%. That's your largest allocation as well. You have over 20% of your portfolio within large cap, your largest equity allocation, I should say. And it's slightly overweight. So the managers and the fact that you're overweight to large cap was a positive for the year. Much of that was Intech. Intech has had a very good couple of years now. And in addition, oddly enough, you might say, well, how could this happen? Your index strategy, the SSGA index, actually outperformed by 8 basis points. Well, index isn't supposed to outperform. How did that happen? There was the large Bank of America class action settlement. The index fund received proceeds from that Bank of America class action settlement. That would not be reflected in the index itself, because the index there's no owner of the index to claim a loss. So that's what that difference in performance is. Small cap outperformed. Big contributors over the last year from an implementation standpoint, meaning asset allocation differences, have been your long-short portfolio. Long-short in a fairly difficult environment, more sideways. This is the kind of environment where we would expect long-short to start to be beneficial. It's not a straight-up environment. It's been like this the last year, markets. Your long-short K2 is up 11.45% for the year versus the fund of funds or hedge fund directional strategic index up 4.7, but more importantly versus the S&P, which is up 11.2. Hedged equity outperformed long-only U.S. equity and certainly outperformed international equity, and is getting there with a lot less risk, as well as the private equity portfolio. This is a small component right now. It's a little more than 3%, but up 13.36%, so very additive. We've seen a lot of distributions. The Singular Guff Distressed Fund, you made a $5 million commitment to that. They've returned all $5 million back to you in distributions, and there's still about $2.5, $3 million left. So when I said we need to continue to build out that program, we need to start adding new funds, because that's winding down, and we'll want to add others. Warburg Pincus, which is another one of your direct managers, they are back in the market raising another fund, and they're one of the premier global growth equity funds out there, so we'll certainly want to be on top of that, and we'll be coming back to you and talking about that in the next month or so. I think no major issues of note. From a performance standpoint in the month, as I mentioned, emerging markets has really been a bloodbath. The index, 1 year down 13% for the broader index. The emerging market small cap index down 7.8%. Your managers, both of them, did very well on a relative basis. They lost a lot less. That's what we would expect them to do. They're much more conservative. Von Tobel, while still down, they're down 5%. That's still an 8% outperformance. Wasatch, small cap oriented, they were down 1% versus 7.8%. So you may recall just 3 months ago, if we looked in April, when China was roaring right before it completely cratered, both of them trailed by about 6% because the benchmark was up 9% in a month, and they're underweight to China. But that underweight to China for both of them has paid off dramatically. So no manager issues. We're starting to see, as you look through, active management, meaning fundamentals are starting to matter again. You're starting to see active managers really be able to deliver some excess return. We think long-short equity is a good proxy for active management. It's been a tough road for long-short equity managers because they have a lot less risk in the portfolio, but when all stocks are going up, like we've really seen from 2009 till 2013, 14, it's hard for those more fundamental-oriented managers to outperform. But now you're starting to see that in a more choppy, sideways, and potentially declining market that we're seeing now. Any questions on anything I didn't?
Do we have anything in here, Jason, where we look specifically at the fees on the individual managers?
Mm-hmm. So we've added that as well, Craig. So go back to the. And I try not to go through the whole book.
No, I understand.
There's so much detail on all the managers, but I'll touch on just. So if you go to page 30, just the first manager. So each individual manager is set up the same way. You have the first page of the manager pages, the upper left, account description, what it is, type of vehicle, so this is it's a commingled fund, the benchmark, your inception date, what the fee is, so the stated fee. So for the State Street Index Fund, it's 4.5 basis points, so very low fee. And then you have characteristics, or you have dollar growth of that portfolio. You can see money coming in and out, and what that portfolio stands at. Upper right, characteristics, sector allocation. Then you have return analytics of the fund, and then on page 32 and 33, more return analysis, and on those pages we drop in the net of fees. So this isn't a good example necessarily, but because the fees are so low, but you can see the,
But then on each one, on each
So on
manager,
each
we'll have that
one-
comparison analysis
Yes.
on a net of fees
yeah, you'll
basis.
see that net of fee, but again, you'll see that net of fee, the gross of fee, the index, and the peer group, but just to keep in.
Great.
So it gives you can get
Perfect.
that look.
Thank you.
It's more meaningful on managers that have higher.
That are
fees.
active managers.
Yeah, more active managers.
Jason, just really quick, will there be any fee changes associated with the peer group change?
No,
Okay.
no. I was just bringing that up so that you were aware of what the peer groups are and just trying to explain that. It's not, you probably won't notice any difference, other than I think the peer group rankings are going to be better initially, just because I've seen the data, and it's, that's what it looks like. Doesn't change the performance, it's still the same performance, it's just ranking it in the, you're not in the Big 12, you're in the whole country now, so.
Okay, item number 12 is comments from board, staff, and citizens. Anybody have any comments? We've got a young man here who attended the meeting for his Eagle Scout badge. We'd like to welcome you. Thanks for coming.
I say.
Absolutely. We'll have one more meeting next month prior to the Public Funds Education Conference down in Norman. We good with that? We don't need to do anything? Okay. All right, we don't have any comments or any questions. We are adjourned, 10:41.